Well, first of all, people have to understand that bonds are debt, and in this system, that's how money is made. And so created, I should say. And so, yes, I do think people need to be very concerned about debt, because if you look at it, whether you're going from, the top down, so a government, a corporation, or an individual, at the end of the day, the laws of economics work the same for everybody. It's just that at this juncture, and particularly with governments and their ability to create debt, and what we see globally, central bankers going in and buying that debt, that really is a big indication that we have some, problems in that market. As I guess you would say, financial power of the world started to shift. I mean, we still hold the world reserve currency status, right, but that's been shifting now. These things don't really happen overnight. So that's really been shifting since, around 2000 is really when they brought in the euro to take over, et cetera. So yes, I do think that the government going in and the Federal Reserve going in and supporting government spending, that's monetizing the government debt. And yeah, I think that's a problem. Let's talk about the printing of currency again, because it costs the same to print a dollar bill as it does to print $100 bill. But you have to work a whole lot more for that $100 bill than you do for that dollar bill. Right. And by the way, there also used to be 500, 1,000, 5,000, 10,000, and even $100,000 bills. They got rid of the ones over 500 or 500 and above as they made the transition from a gold-backed currency to a debt-backed currency. And they didn't demonetize it like they did in India and say, oh, this is no longer money. Yeah. They just very quietly withdrew it. So if you made a deposit, then those bills never came back out in circulation. And so hence today we don't realize. But that was a way to hold a lot of wealth in a very small package. And that's not what they want. And so they don't want you to have cash today, because that eliminates cash is actually a debt instrument that holds zero coupon, right? So it protects your principal, doesn't protect your purchasing power. It protects your principal, but it eliminates or creates challenges with them taking it as deeply negative as they need to get you to spend it. When they were creating this whole system, this was actually the debate. Corporations wanted to be able to pay you less, but they knew if you were used to getting $10, you weren't going to accept $5. However, if they created the inflation so that they paid you $10 or they paid you $15, but it actually spent like $5, then they could get away with it. So this was part of the plan. What you just said, absolutely part of the whole plan. Because if, on the other hand, you got paid in gold, which has the most functionality of anything and the broadest base of buyer of any asset as well, if you had gotten paid in ounces of gold back in 1971, don't hold me to this, but I have the data, it would have been something like 235 ounces. If you did not get a raise, but you were paid in the same amount of gold, I think that worked out when I did the calculation the last time to like $341,000. I think that this is my opinion, but they haven't been able to hit on what they measure. Okay. We have to be specific, because if you and I are living in the real world, we know they more than hit their 2% target. They're closer in most cases to 10%. But in what they monitor, they have not been able to hit that 2% target since 2008, right? Right. And so when they couldn't hit that, then they came out and said, well, we're going to go for an average. And at that time, I said, that's because they're starting to lose control of interest rates. And they know it's going to run a whole lot hotter. And so they're getting us used to that so they can come out and say, like they have, right? Well, we're going for an average here. we're not going to do anything. We want this inflation because you have to get rid of the old system before you can really fully go into the new system. And, one of the things that tells me how close we are to it, frankly, is the average person getting into the stocks and the bond market and the real estate market as an investment, because we saw the same pattern in 1928. That's when the general public, who got credit for the first time, go on margin for the first time. But that was right at the point where the industrialists and the people that understood that it was just a paper market and how fragile and vulnerable it was,
Yeah.
they were selling out to the general population. And then the credit was pulled out from the public because we were not, again, too big to fail in 1929, and we had that crash. And if you look at every major crash, like I was there on Black Monday in 1987. I was a new stockbroker. I was about a year into it. And because I was not the best day I could have ever been a stockbroker, I'm telling you, what I learned that day and then after that was just amazing. But I have to tell you, that was the start of globalization. That was really the start of the system. And so everything looks hunky-dory for a while, and lots of people are doing really well. And then all of a sudden, the rug gets pulled out from under you. And the other thing I'd like to kind of point out here, Kevin, if you look at the World Economic Forum symposium that's coming up, well, you own nothing and you're happy. Well, if you don't own it, somebody else does, because wealth never disappears. It merely shifts location. So if you hold all of your wealth in intangibles, and and all you can convert it into is the dollar that has zero value, what do you have? That's why, I just have my little silver things here and gold things, but that's why you've got to have intangibles outside of the system in order to, and real money, so that you're in a position to take advantage of those opportunities when they present, because nobody's going to know when this whole thing is just going to come crashing down. I'm not willing to put my technical neck on the line yet, but I think a great place to watch it is the monetary velocity at the Federal Reserve's website, the Fed. Because when that starts going up in a pervasive way, what that monitors is the speed at which money changes hands. And what will create the hyperinflation is a lot of those dollars chasing a finite amount of goods.